Hi dear traders! Last week's trading sentiment was predominantly optimistic. On Friday, US stock indices hit their all-time highs, buoyed by strong corporate earnings reports. The currency market also reflected this upbeat mood. The US dollar index, which tracks the dollar against the basket of six major currencies, saw a gain of 0.78% last week, solidifying its position above the 103-point level. The demand for the dollar was driven by robust US macroeconomic data. Encouraging retail sales and industrial figures allowed investors to shift their focus to the Fed's statements. Most officials, citing the strength and potential of the American economy, advocated maintaining the current interest rate. These political signals reduced the likelihood of a policy easing at the Fed's March meeting to 57%, down from 75% previous week. The euro ended the week down by 0.48%, falling below the key level of 1.2900, which had been the lower boundary of 5-week sideways trend. European policymakers rushed to assert their firm stance, helping the euro avoid a sharp collapse. Like their American counterparts, European Central Bank officials are not in a hurry to cut rates. ECB President Christine Lagarde hinted at the Davos Economic Forum that rate cuts might be discussed in the summer, but not earlier. Last week was filled with a series of reports on the state of the British economy, all of which were decidedly negative. The UK economy is struggling and certainly in need of stimulus from the central bank. However, the Bank of England is unlikely to make any drastic changes. Judging by the pound-dollar movement, investors are still hesitant to sell off the pound aggressively. The Japanese yen tells a different story. Investors have been waiting for the Bank of Japan to raise rates for years. The dollar-yen pair returned to its 7-week high. Investors understand that after the recent earthquake, the Japan Central Bank is unlikely to change its monetary policy course. Inflation levels are still above the central bank's target of 2%, a key condition for a rate hike. The weakening of the yen is likely to continue until tomorrow's meeting of the Bank of Japan, which is expected to leave everything as it is. As usual, central bank interest rate policies impacted gold prices, leading to a 1.12% drop in precious metal. Financial market participants are moving their funds to more profitable assets. With the Fed not planning to cut rates, it becomes more profitable to keep savings in US bonds rather than gold. Thus, the price of gold has dropped from its highs to around $2,020 per troy ounce, but is unlikely to fall further. Last week's oil trading was also highly volatile. The price of BRENT crude was hovering around $78 per barrel. Escalating tensions in the Middle East, including attacks in Yemen and ongoing Houthi attacks in the Red Sea, inevitably influenced energy prices. Meanwhile, the International Energy Agency forecasted an increase in oil demand, further supporting the rise in oil prices. These are the trends of the last trading week. Do not miss our daily news reports to be always in touch with the latest events. See you!